Eurozone economy Q2 growth holds better than feared at 0.1%. U.S. economy grows at a 3% rate in Q2. And Bank of Canada holds key rates steady. Welcome to our economic bulletin with me, Hala Al-Hamalawi. The European Commission has stated that 18 European Union countries applied for billions of euros from a new defense fund aimed at helping Europe provide for its own security, with Poland seeking more than a third of the money. The Commission noted that the initial strong interest allowed it to prepare to raise funds on capital markets. It noted that the countries that have so far shown interest are Belgium, Bulgaria, Czech Republic, Estonia, Greece, Spain, France, Croatia, Italy, Cyprus, Latvia, Lithuania, Hungary, Poland, Portugal, Romania, Slovakia and Finland. Eurostat has reported that Eurozone economic growth held up better than feared last quarter, suggesting that businesses are adapting to trade uncertainty, potentially reducing the need for more European Central Bank interest rate cuts to stimulate the bloc. Gross domestic product in the 20 nations sharing the euro currency expanded by 0.1%. Data also revealed that Spain, France, Ireland continued to perform above expectations, offsetting weakness in Germany and Italy. However, the data still indicate a big slowdown compared with a 0.6% expansion in the first quarter. Spain, in particular, demonstrated stronger than anticipated growth despite global trade uncertainties, with national output GDP growing by 0.7% quarter-on-quarter from April to June. Spanish National Statistics Institute revealed that the GDP jumped by 2.8% year-on-year. Domestic demand has been key, contributing 0.9 percentage points to quarterly growth. Additionally, data has shown that Portugal's economy bounced back to expand 0.6% in the second quarter from the previous three-month period, when it shrank a revised 0.4%. The gross domestic product also grew 1.9% year-on-year, in an acceleration from a 1.7% growth in January to March. The National Statistics Institute added that the contribution of net external demand to the quarter-on-quarter change in GDP was less negative than in the previous quarter, with exports of goods and services registering growth after dropping in the previous quarter. Notably, the French economy has grown 0.3% in the second quarter, beating forecasts as a rebound in household spending boosted the Eurozone's second biggest economy. The growth also showed an improvement from France's Q1 GDP growth of 0.1%. Finance Minister Éric Lombard noted that the preliminary Q2 GDP growth figures were nevertheless good news. He added that figures showed that the French economy was faring relatively well, given the pressures from the framework trade tariffs deal between the EU and the US. In contrast, the statistics office Distatis has revealed that Germany's economy contracted by 0.1% in the second quarter as demand from the United States slowed following months of strong purchases in anticipation of U.S. tariffs. The status data also signaled that investment in machinery and equipment, as well as construction, were lower in the second quarter than in the previous 3-month period, while private and government consumption expenditures increased. The National Statistics Bureau Istat data has shown that the Italian economy unexpectedly shrank by 0.1% in the second quarter compared to the first, possibly reflecting the early impact of a rise in U.S. tariffs and global trade uncertainty. Gross domestic product grew 0.4% in the second quarter on an annual basis. Istat noted that the quarterly GDP decrease between April and June was due to negative trade flows that offset domestic demand. It added that Italy's first quarter GDP growth estimate was unrevised at 0.3% from the preceding quarter and 0.7% year-on-year.
Eurozone economy in mid-2025 faces a challenging environment marked by trade policy uncertainties, tariffs, and geopolitical tensions. GDP growth is modest, with the IMF projecting 1% growth in 2025 and a pickup up to 1.2 to 1.4% in 2026, broadly in line with European Commission forecasts. Goldman Sachs similarly expects slow but stabilizing growth, supported by gradual easing of trade tensions and a rebound in investment. Inflation is easing faster than anticipated, with headline inflation around 2.1% in 2025 per earlier estimates, while the IMF forecasts inflation broadly at targeting from mid-2025 and returning to 2% core inflation by 2026. Wage growth remains above pre-pandemic levels, but is set to moderate. The ECB has begun monetary easing, anticipating further rate cuts as disinflation progresses. Labor markets remain resilient, with unemployment around 6.3% in 2025, are slightly improving thereafter. Key risks identified by both IMF and Goldman Sachs include ongoing US-EU tariff uncertainty, geopolitical conflicts impacting confidence and spending, and subdued domestic demand. Fiscal policy has partly mitigated external headwinds, with potential expansions in defense and infrastructure spending supporting activity. Investment is expected to benefit moderately from EU-wide funding initiatives. Social challenges persist, including about 93 million people at risk of poverty or social exclusion in 2024.
For further analysis, we're joined from London by political and economic analyst Mr. Babak Imamian. Welcome to Qnews Economic Bulletin. And sir, I would like to start by asking you, how do you interpret the recent Eurozone economic data showing a slight 0.1% GDP growth in quarter 2 2025 and the uptick in economic activity in July, especially in the services sector?
Well, thank you for your question. This 1% economic growth is not something to be celebrated. Right now, realistically, we need the economy to be growing in Europe generally by not only Eurozone, but I mean United Kingdom and other countries around Eurozone by about 5 to 6%. But right now, we have the legacy of COVID, and also we are going through the legacy of Ukraine war, which I think it has impacted the Eurozone or European economy in terms of changing it from consumer goods economies now to military economies. That's what we see. There is that change from consumer goods economy to military economy. Also, the other aspect of it is the Ukraine war. Not only it has produced high energy costs, not only it has created high inflation, also Europe has lost a market, the Russian market. So the sooner the Ukraine war is sorted out, the better it will be for Europe.
So how significant is the impact of easing inflation pressures, with Eurozone inflation steadying at around 2% and services inflation rising slightly for the overall economic recovery?
Well, in comparison, the inflation rate is very good. And the ECB, also the rate cuts, they've been very helpful. And we are expecting 2 more rate cuts. So ECB is, if we quote President Donald Trump, they are doing much better than the Federal Reserve are doing, or in this case, Bank of England, which the rate is at 5.25%, 4.25%, much higher than the 2% of ECB. So I think both in terms of what ECB is doing doing great job in stimulating the economy in the Eurozone.
Mm-hmm. So can the recent stabilization in factory activity and modest hiring increases in the Eurozone be seen as some sort of signs of sustainable growth, or are these just improvements fragile?
Well, it all depends on what business model are we looking for Europe. Europe was very much involved in globalization, where all the jobs went to China, all the production went to China, and corporates made money by having cheap products, selling them into Europe. Mm-hmm. Now we are going through re-globalization because they realized globalization did nothing for the small businesses in Eurozone and for the rural industries. Mm-hmm. So this process of going through re-globalization, where manufacturing is coming back to Europe, part of it is the defense fund, European Defense Fund, and also, again, expanding the military industry in Europe is a part of the reindustrialization of Eurozone.
Mm-hmm. To what extent is the Eurozone's economic recovery dependent on external factors like global commodity prices or U.S. economic policies?
Well, it all depends on what markets you're going to export with, or what trade treaties you have with international markets. Right now, Europe has been so preoccupied with the effects of Ukraine war and actually handling the Ukrainian war that they've lost concentration on international affairs. They are far behind. You don't see them. You see them hardly involved in the Middle East or even in other countries. And that's the reason this Ukraine war has had a psychological as well as economical effect on Europe.
Mm-hmm. How might increasing the defense budget in the Eurozone impact the overall economic performance in both the short and medium term?
Short term, it will be fine. There is a plan for Europe to, in terms of industrial military, decouple itself from United States. That would take, they say, something like 800 billion euro of investment, and it would take at least 10 years. Mm-hmm. So I would say in short term, it will not be that much. But again, in the short term, there is something like 50 to 100 billion going into the industry. So it is expanding, but then military industry, there has a limit how it improves the economy. A good economy is based on consumer good economy rather than a military economy.
Okay. So could higher defense spending stimulate economic growth through job creation, industrial activity, or technological innovation, or might it crowd out other productive public investments?
Well, for all these things that you mentioned, you need long-term projects. But what Europe suffers from is they have too many short-term governments keep changing the policies of the previous government. So whatever we say now, or whatever the present governments are saying or planning, there is no reason that the next government in 2 years' time or 4 years' time will not reverse those policies. So that's one of the things about Europe, that long-term policies are not
effective or sustainable in a way, right? Mm-hmm. Yeah. What are the potential fiscal risks associated with boosting defense expenditures amid all these efforts to maintain inflation targets and fiscal discipline?
Well, right now, Europeans have concentrated too much on social benefits, and cutting back on those to actually increase this defense spending is going to have a political ramification, and also it would make a lot of people upset because their social benefits will be cut. So there is that aspect of it. Then again, we come, which politicians are prepared to go through that pain?
Okay, and how might increased defense expenditures affect the Eurozone's trade balance given the dependencies on imported defense materials or exports?
Then again, I go back, it would take at least 10 years for the, let's call it, European military industrial complex to actually become a viable force. So nothing immediately. It would take at least something like 10 years. And that is, again, if all the governments commit to that project the next 10 years.
Well, from London, that was political and economic analyst Mr. Babak Imamyan. Thank you so much for your insights. And now we move on to the latest developments from all over the United States. The Commerce Department has reported that the U.S. economy expanded sharply in the second quarter as businesses dialed back on imports after stocking up earlier in the year to get ahead of President Donald Trump's tariffs. The gross domestic product registered an annualized rate of 3% in the April through June period, up sharply from the 0.5% rate in the first quarter. Consumer spending rose 1.4% in the second quarter, better than the 0.5% in the prior period, while exports declined 1.8% during the period and imports fell 30.3%, reversing a 37.9% surge in quarter one. U.S. President Donald Trump has stated that the United States will impose a 25% tariff on goods imported from India starting August the 1st. Trump wrote in a post on Truth Social that he stated that although India was a friend, they had historically conducted little business with them because India's tariffs were excessively high, among the highest globally, and the country maintained the most strenuous and objectable non-monetary trade barriers. Trump said that India will also face an unspecified penalty on August the 1st, but he did elaborate on the amount or what it was for. In Asia, Singapore's central bank, the Monetary Authority of Singapore, MAS, has maintained its monetary policy settings, keeping the exchange rate policy bands, appreciation rate unchanged. This decision came after better than expected second quarter economic growth and an easing of global trade tensions. MAS noted a reduced near-term risk of a sharp global growth decline and more benign financial conditions. However, the outlook for Singapore's economy remains highly uncertain, particularly for 2026. The effective U.S. tariff rate on Singapore's exports has also risen to 7.8% from 6.8% in April. Moving on to North America, the Bank of Canada held its key policy rate at 2.75% for the third time in a row and said that the risk of a severe and escalating global trade war had diminished. The bank also noted that if the economy weakened further, it could cut rates, provided upward pressures on inflation were kept in check. Bank Governor Tim McClem stated that Canada's economy was showing some resilience, and while inflation was close to their 2% target, they observed evidence of underlying inflationary pressures. Meanwhile, in South America, National Statistics Agency INEGI has reported that Mexico's economy grew 0.7% in the second quarter from the previous three-month period, beating market expectations. Secondary and tertiary activities, respectively covering manufacturing and services, grew 0.8% and 0.7% on a sequential basis. Year-on-year growth in the second quarter hit 0.1%. Moving on to the latest developments across Russia and the Pacific, the Argus media has reported that a powerful magnitude 8.8 earthquake of Russia's Kamchatka Peninsula has caused localized damage and minor injuries, but initial assessments indicate that a minimal broader economic impact, particularly to crucial commodity infrastructure. It also reported that while tsunami waves hit parts of Kamchatka and the Kuril Islands, damaging the Severokurilsk port and a kindergarten, crucial facilities like Sakhalin LNG and key ports appear unaffected, limiting broader economic fallout. For further analysis, we're joined from Moscow by visiting lecturer and Higher School of Economics, Mr. Rami Al-Qalyoubi. Welcome to Qnews Economic Bulletin. Mr. Rami, now given the initial reports of the localized damage but no significant disruption to major commodity exports, how might this earthquake's economic recovery differ from past large-scale seismic events that hit more industrialized or densely populated areas?
I don't think it will have any major effect because actually the earthquake took place in a very far region at the Russian Far East next to Kamchatka Peninsula. So it's quite far from any Russian economic major centers, which is locally. But globally, of course, there should be made some surveys and studies because now in the 21st century there is a climate change. There are many natural transformations, and of course the international community should unite to face these challenges and to put political disputes apart. So this is of course crucial in the 21st century.
So beyond direct physical damage, what potential indirect economic consequences, like for example supply chain disruptions, shifts in local labor markets, or consumer confidence changes could arise from this earthquake, even if it deemed minimal in overall impact?
No changes, because actually this Kamchatka Peninsula is of volcanic origin and there are quite many mountains, so this is not really economically diverse or important area. All Russian areas from the economic point of view are concentrated either in the European part of Russia or in the far north where the oil fields are located. So there will be no effect on economics or supply chains.
Okay, so considering the stated minimal commodity damage in key export hubs like Sakhalin LNG, what specific factors or pre-existing resilience measures do you believe prevented a more severe economic blow to Russia's energy sector?
Actually, as I mentioned, the Russian energy sector relies on the gas and oil is concentrated either in Siberia or in some northern parts of Russia. And on one hand, this is an obstacle because it's quite difficult to develop northern fields. But on the other hand, these areas are quite safe from the point of view of seismic point of view. So, and this is hinders very.
And how might this earthquake, despite its limited broader economic impact, influence future investment decisions in infrastructure development or disaster preparedness within Russia's far eastern regions?
No, of course, there should be made some surveys, and any future infrastructure to be built should take into consideration that it is seismic risk, as well as Japan always puts these considerations while construction. So Russia should follow this example in the Far East areas.
Mm-hmm. From Moscow, that was visiting lecturer at the Higher School of Economics, Mr. Romel Kariloubi. Thank you so much for joining us in Qnews. And now, ladies and gentlemen, we move on to the latest developments from the commodities sector. Energy Minister Alparslan Bayraktar announced that Turkey will begin supplying Syria with natural gas from August the 2nd. And this includes gas from Azerbaijan sent via a swap agreement and transported through Qnews to Syria. He stated that the 6 million cubic meters of gas supplied will generate 1,200 megawatts of electricity. And he added that Ankara will further aid Syria's energy needs by providing an additional 500 megawatts of its own electricity. Oil prices steadied on Wednesday as investors awaited developments on U.S. President Donald Trump's tighter deadline for Russia to end the war in Ukraine and also his tariff threats to countries that trade its oil. The Brent crude futures were down about 0.1% at $71.63 a barrel. U.S. West Texas Intermediate crude slipped to $69.61 a barrel. Gold fell on Wednesday as solid U.S. economic data reinforced expectations that the Federal Reserve will hold interest rates steady at its upcoming meeting, while also increasing the likelihood that rate cuts may be pushed back for the remainder of the year. Spot gold was down 0.6% at $3,306.57 per ounce. U.S. gold futures fell 0.6% to $3,303.4. JP Morgan Chase has announced a strategic integration with cryptocurrency exchange Coinbase, marking a significant step in bridging traditional finance with digital assets. Under partnership, Chase credit card holders will be able to use their cards to purchase cryptocurrencies on Coinbase starting this fall. Additionally, customers will be able to redeem JP Morgan's Chase Ultimate Rewards points for USDC, a stablecoin, in 2026. The integration also includes a feature allowing Chase card holders to directly link their accounts to Coinbase, streamlining the process of purchasing cryptocurrencies. Global markets are seeing a mixed performance as of Wednesday evening, with European indices and U.S. futures mostly posting gains, while Asia markets show slight declines and present a varied picture. In the U.S., S&P 500 futures edged up 0.05% and Nasdaq futures increased 0.21%, while Dow Jones Industrial Average futures inched down 0.12%. Across Europe, the UK's FTSE 100 declined 0.04%, while Germany's DAX rose 0.19% and France's CAC 40 hiked 0.22%. In Asia, the Shanghai Composite rose 0.17%, while Hong Kong's Hang Seng Index dipped 1.36%, and Japan's Nikkei 225 fell 0.05%. And that brings us to the end of our economic bulletin, and here is what we have been covering. Eurozone economy Q2 growth holds better than feared at 0.1%. U.S. economy grows at a 3% rate in Q2. And Bank of Canada holds key rates steady. And this concludes our economic bulletin. Don't forget to follow Q News on YouTube, Facebook, X, Instagram, and TikTok at QNewsEG to stay informed. My name is Hala Al-Hamalawi. Thank you so much for being with us, and stay tuned for more updates here on Q News.